If you blinked in the last 24 hours, you missed the moment the foundation of the global silver market fundamentally shifted. This is not a drill. This is not a maybe. We are witnessing 4 separate high-velocity developments hitting the tape almost simultaneously. Individually, they are significant. Together, they represent a total systemic reset. I am your host, and you are watching Analysis with AG. And today, we are going behind the curtain of the most manipulated asset on Earth. Before we dive into the mathematics of this collapse, I need your help. The algorithm wants to bury this data. It wants to keep you focused on the paper price while the physical metal disappears. Hit the like button and comment silver reset right now. It takes 2 seconds, but it tells the system that the truth cannot be suppressed. We are fighting a war of data against narrative. Let's begin. The financial media wants you to believe that silver is dead. They point to the recent 46% crash as proof that the bubble has popped. They want you to look at the screen, see the red numbers, and walk away. But while you were being told to look at the exit, the most powerful players in the world were quietly locking the doors. We are seeing a great divorce between the price you see on your phone and the price required to actually move physical metal. Let's start with the policy bombshell that should be front-page news, but isn't. The United States government has effectively admitted that the free market for silver is broken. Under Secretary of State Jacob Hellberg recently confirmed that the U.S. is developing a formal price floor system for critical minerals. This isn't a theory. This is a strategic intervention. Think about the gravity of that statement. Governments do not step in to create price floors for assets that are healthy. They step in when an asset is so strategically vital and so dangerously underpriced that it threatens national security. This policy didn't emerge from a vacuum. On February 4th, Vice President J.D. Vance stood before representatives from 55 nations and laid the cards on the table. He stated the U.S. would establish reference prices at every stage of production. For those of you who don't speak bureaucrat, let me translate. The United States is setting a minimum price for silver and other critical minerals. If the market price drops below that level, the government will use adjustable tariffs to force the price back up. They are building a cage around the downside. Why now? Because they've realized that silver isn't just for coins or jewelry. It is the literal nervous system of the modern world. It's in your Tomahawk missiles, your F-35 sensors, your semiconductors, and every solar panel intended to power the green transition. If China controls the supply and the paper market suppresses the price, the U.S. mining industry dies. To prevent that, the administration unveiled Project Vault, a $12 billion strategic reserve. $10 billion from the Export-Import Bank, $2 billion from private equity. Its sole purpose? To stockpile minerals and stabilize prices. When this announcement dropped, silver was trading around $74, down from its spike of $121. By intervening at $74, the government is signaling that even at that level, silver is too cheap for the system to function. They are drawing a line in the sand. This is the first time in decades we have seen a government-backed safety net placed under a commodity. The paper shorts are now betting against the U.S. Treasury. That is a losing bet. But if you think the government's admission is shocking, wait until you see what's happening at the mines. Hecla Mining Company is the largest primary silver producer in North America. They just released their full-year results, and the numbers are generational. Their revenue is up over 53%, and their net income didn't just grow, it exploded by 900% in a single year. But forget the profits for a second. Look at the price realization. During the fourth quarter, the average benchmark price for silver, the one you see on the news, was roughly $54. But Hecla didn't sell their silver for $54. Their audited financials show they realized an average price of $69.28. That is a $14 premium. That is 30% above the market price. Ask yourself, how does the largest miner in North America get paid 30% more than the official exchange price? It's because the industrial giants, the Samsungs, the Apples, the defense contractors have stopped trusting the Comex. They are bypassing the paper exchanges and going directly to the source. They are saying, keep your paper contracts, we need the physical metal to keep our factories running, and we will pay whatever it takes to secure it. When the real price paid by industry is 30% higher than the fake price on the screen, the exchange has lost its purpose. We are witnessing the death of the benchmark. Hecla is so confident in this decoupling that they are selling off their gold mines for $600 million just to go all in on silver. Think about that. Gold is at $5,000, and the experts at Hecla are pivoting towards silver. They know something the general public doesn't. Their all-in sustaining costs are $18. They are selling at nearly $70. These are margins that shouldn't exist in a normal market. They are getting paid to produce silver because the byproduct credits from other metals are covering their entire overhead. It is a license to print money backed by physical scarcity. Now, let's look at the retail level, because this is where the system failure becomes undeniable. APMEX is the titan of the industry. They're the largest online precious metals dealer in the United States. They have the warehouses, the logistics, and the history, and for the last month, they were effectively broken. CEO Ken Lewis recently had to issue a public apology for massive shipping delays. For weeks, the largest dealer in the country couldn't get metal out the door. They were forced to slash their product offerings from thousands of items down to just 31 core products. They could only keep 21 of those in stock. They had to increase their customer service staff by 25% just to handle the "where is my silver" phone calls. Their weekend order volume was 7 times higher than normal. This wasn't just a busy month. This was a supply chain snap. When the price crashed 46% on January 30th, the mainstream narrative said that everyone was selling. The data says the exact opposite. People weren't selling. They were raiding the vaults. The demand was so violent that it overwhelmed the most sophisticated logistics network in the precious metals space. If it takes 18 days for the world's largest dealer to catch up after a price dip, what happens during the next leg up? What happens when the price crosses $80, $90, or $100 and the FOMO, the fear of missing out, really kicks in? The infrastructure is already at its breaking point. The next wave of demand won't just cause delays, it will cause empty shelves. We are moving toward a request for quote market, where the price is whatever the person holding the metal says it is. Finally, we have to talk about the derivatives market, because this is the loaded spring. Right now, there are approximately 35,000 call options for the MarchCom box silver futures that are in the money. These aren't just bets. These are legal contracts that give the holder the right to buy silver at prices significantly lower than where it's trading today. On January 30th, the big banks tried to kill these options. They slammed the price from $121 down to $64 in a single day. It was a tactical strike designed to wipe out the longs and force them to abandon their positions. It was the most violent drop in nearly half a century, and it failed. Despite that 46% haircut, 35,000 contracts survived. They are still standing. Silver has already clawed its way back from $64 to $78. Every cent it rises puts more pressure on the shorts, who have to hedge their exposure. Each one of those contracts represents 5,000 ounces of silver. Do the math. 35,000 contracts multiplied by 5,000 ounces is 175 million ounces of potential delivery demand. How much silver is actually in the registered Comex vaults? Roughly 98 million ounces. The math doesn't work. The paper promises outweigh the physical metal by nearly 2 to 1 on the single option series alone. Now, the skeptics will tell you that most people settle for cash. They'll tell you that nobody actually wants the bars. But remember what we just discussed. Industrial buyers are already paying 30% premiums to miners. If you're a manufacturer and you can exercise a contract to get silver at $78 when the real physical price is $90 or $100, why would you take cash? You would take the metal. You would take every single ounce and run. This is the arbitrage trap. The banks have suppressed the paper price for so long they've created a massive incentive for people to stand for delivery. They have made the physical metal cheaper than its true value, and the smart money is starting to call their bluff. February delivery rates are already running at 98% of contract size. That is unheard of. It means the people holding these contracts aren't traders, they are owners. Connect the dots with me. We have a government-backed price floor being built by the U.S. Treasury. We have the largest miner in the country realizing a $14 premium over the exchange price. We have the largest retail dealer overwhelmed and running out of stock. And we have an options market where the demand for delivery could potentially double the available supply in the vaults. This isn't a bull market. This is a structural repricing of a strategic asset. The world is waking up to the fact that you cannot run a high-tech civilization on paper contracts. You need the atoms. You need the silver. The volatility you are seeing, the massive swings, the flash crashes, this is the death rattle of the old system. The banks are trying to shake the tree one last time before the great divorce is finalized. They want you to be afraid. They want you to look at the volatility and think risk. But the real risk isn't the price moving. The real risk is being stuck in a paper system when the physical doors lock for good. Governments don't build project vaults for fun. They don't coordinate with 55 allied nations to stabilize prices unless they are terrified of a supply cliff. They see the data. They see the 6-year structural deficit. They see the mining production falling while industrial demand for AI, solar, and defense is vertical. They know that the screen price is a lie, and they are preparing for the day the lie can no longer be sustained. If you were waiting for a safe time to enter, you were waiting for the price to be much, much higher. By the time the mainstream media admits that the physical market has decoupled, the premiums will be so high that the average person will be priced out. We are already seeing it with Hecla. We are already seeing it with Hecla. We are already seeing it with APMEX. The retail price and the institutional price are leaving the paper price in the dust. I want you to think about the mathematics of your own position. If you hold physical silver, you are holding one of the few assets on Earth that is currently being floor protected by the most powerful government in history, while simultaneously being premium driven by the world's largest industrial manufacturers. You are on the same side as the US Treasury and the tech giants, and on the opposite side of the over-leveraged bullion banks. I know which side of that trade I want to be on. We are entering a period of price integrity. For decades, the price of silver was determined by how many paper contracts the banks could print. That era is ending. The new era will be determined by how many ounces are actually in the vault. And as we've seen from the APMEX shipping delays and the Hecla realization prices, there aren't nearly enough ounces to go around. This is the moment where you have to decide if you believe the narrative or the data. The narrative says silver is a Barbaru relic that just crashed. The data says silver is a strategic mineral with a government-guaranteed floor and a 30% physical premium. The narrative says the vaults are full. The data says the options market is a ticking time bomb. I am telling you this because the windows of opportunity in these types of resets are incredibly small. We saw it in 2020 with the nickel market. We saw it with rhodium. When the shorts get trapped and the physical supply vanishes, the price doesn't go up by percentages, it goes up by multiples. And it happens overnight. The algorithm wants to bury this video. It doesn't want this level of detailed analysis reaching the public. So I'm asking you again, like this video, subscribe to the channel, share this with one person who still thinks the screen price is the real price. We have to spread the data before the next leg of the reset begins. Let's look at the macro picture one more time. Gold is hovering around $5,000. The gold to silver ratio is screaming that silver is the most undervalued asset in the complex. If silver were to simply return to its historical ratio with $5,000 gold, we wouldn't be talking about $78. We would be talking about 3-digit silver as a starting point. And now you have the Vance floor. You have a political mandate to keep these prices high enough to ensure domestic mining stays profitable. That means the downside is being removed by policy, while the upside is being driven by a physical shortage. That is the perfect asymmetric trade. I've been tracking this market for a long time, and I have never seen this many signals align. Policy, production, retail demand, and derivatives are all shouting the same thing. The paper era is over. The physical era has begun. Some will call this alarmist. I call it arithmetic. You cannot have a 900% increase in miner profits and a 30% premium over spot without acknowledging that the system is broken. You cannot have the largest dealer in America stop shipping for a month and claim that supply is plentiful. The great divorce is here. The paper price is a ghost. The physical metal is the reality. Are you holding the ghost, or are you holding the reality? As we move into the next month, watch the first notice day for the March contracts. Watch the delivery numbers. Watch to see if the US Treasury officially sets that reference price, because the moment that number is published, it becomes the new floor for the entire world. And my guess, that floor is going to be a lot higher than $78. Thank you for being part of this community. Thank you for seeking the truth in a world of manipulated headlines. This is Analysis with AG. Stay focused, stay physical, and don't let the volatility shake you out of a generational position. The math is on our side. I want to hear from you in the comments. What is your honest number for silver by the end of 2026? Now that you know about the government floor and the miner premiums, has your thesis changed? Let's get the conversation started. The doors are locking. The vault is emptying. The algorithm is trying to hide it. But now you know the truth. This is the hidden economy. This is the silver reset, and it has only just begun. I'll see you in the next one. Stay vigilant.